while some online bullion dealers continue to charge almost $2 over spot for 1 ounce silver rounds, SD Bullion is selling 1 ounce silver rounds at only 49 cents over spot on any quantity. Again, that's $9.99 fine silver for just 49 cents over spot for any quantity. If you haven't joined the over 40,000 precious metals investors by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Dave Kranzler. Dave, it's great to have you back on the show.
It's always great to be on this show. Thanks for having me back on.
Yeah, it's always great to have you, Dave.
I appreciate that.
It's been a bit of a whiplash week in the metals here this week. Of course, on, what was it, Monday or Tuesday, we had the big smash at, I think, about 4 a.m. Eastern. And then yesterday on Wednesday, metals popped. And then here again, early morning here on Thursday, metals smashed again. Gold's hit back under 1250s, currently trading about 1245. Silver traded down to about 1660. It's trading right around 1665, 1670 right now. What do you make of the trading action this week here, Dave?
Well, I think the best comment I heard all week was yours when we were chatting a little earlier that, how come these fat finger trades never seem to hit the buy button in gold?
Still waiting for that. We were joking. Yeah. We were joking before the show that you'd think one of these times they'd mess up and they'd accidentally have a true fat finger and they'd accidentally hit the buy button and, crap, what happened? Gold's at 1,500. That hasn't happened yet.
Well, if it did happen, they'd probably figure out a way to unwind the trades and start over.
It wouldn't take long.
Yeah. Oh, well.
We'd have a market closure and everything's unwound, and that was a big mistake.
Yeah. Sorry, guys. Take one for the team. Well, I think the trading action this week, and I wasn't really focusing on it graphically until we were just chatting about it a little earlier. It looks like in this latest downtrend in gold that kind of started in early June when gold was it was testing 1,300, and of course they weren't going to let it go over 1,300. I think 1,320 has been identified by a lot of technicians as an area where there's these so-called pivots where a lot of buy orders from hedge funds kick in. So I think they always protect round numbers like 1,300, and it makes it easier to protect 1,320 if they can keep it from getting over 1,300. So I think that's what happened, and I think that's probably what set off the latest sell-off in gold, the latest swoon. But what's interesting, and as I mentioned earlier, I hadn't really focused on it until we were chatting about it a little earlier. Since late last week, gold is they're not able to really push it below the 1240 to 1245 area. So like when I woke up this morning, I never know what to expect when I turn on the screens, about what happened while I was sleeping in the gold market, because there's just so much intervention going on, especially now. But I saw that gold was down $8 or $9. It was right at 1240. And I was like, what the heck happened? And of course there was no news, and the dollar was lower, so it didn't make sense that gold would be lower. But it looks like, at least for now, they can't get it below the 1240 level. And it seems to have maybe carved out a bottom here, assuming they can't push it below 1240 and keep it below 1240. That's not to say they might not, Monday when no one's around, bomb the crap out of the COMEX Globex system with paper and push it down below 1240, but I guarantee you that won't last. Well, I don't want to guarantee, but I'm confident that wouldn't last. But this area, this 1240 to 1245 range, is kind of fitting a pattern of higher lows that's occurred ever since the end of January or the end of December, beginning of the year. So, it's an interesting. the trading action is really a lot more interesting than it looks if you're just living on the day in and day out movements. So, and I do think that a higher price of gold, or at least the inability to push it lower from here with papers being supported by the physical demand that's coming from, the usual suspects in the Eastern Hemisphere.
Even the paper buyers on COMEX are coming in and buying, possibly recognizing that this underlying physical demand is in fact our object reality, as opposed to what's reported in the news media. And recently we just had the World Gold Council poo-pooing Chinese demand because they're looking at the Hong Kong import window as being, excessively important in terms of trying to assess how much gold China is consuming. And China's partially dark. We simply don't know. They're not even reporting the monthly tabulations that China started doing before they were trying to get into the SDR basket back in October. And then once they got in the basket, they stopped reporting their monthly reports. So, China, they don't want the world to know how much gold they're going to get. And just playing along with the manipulation because it allows them to buy at a lower price.
That seems to be what China's doing. They really don't want the whole world to know what they're doing with their gold imports. I mean, as you mentioned, they don't report the gold that goes through Beijing or Shanghai, and that's intentional. And I can recall getting an article about it from, I think it's called the South China News or something. South China Morning Post. And it specifically said in there that they are purposely not reporting the official numbers that move through Beijing and Shanghai. And so when you see the World Gold Council or some of these other, anti-gold propagandist organizations identifying Chinese demand with the amount of gold that is moving into China from Hong Kong, I mean, that may even only be a third of the gold moving into China. We don't know.
Yeah, it's certainly less than half. And the entire Wall Street community, the South Side research community for brokerage houses, I mean, everything keys off of organizations like the World Gold Council. Most of the analysts that are covering gold, as few as there are not really diving all that deep, and they just take the industry standard stuff and they parrots it, and then the media parrots it, and then you have this echo chamber effect of people assuming that gold demand in China is down. You talk about fake news.
I'll tell you what's interesting, Eric, because you referenced the paper market, and I just pulled up the COT report from that was last Friday, so obviously it's more than a week old in terms of what the positions look like. But through the previous Tuesday, the producer and swap dealer category, which is primarily the bullion banks, the COMEX bullion banks, they knocked down their short position by about 34,000 contracts. I mean, that's a pretty big drop in the net short position of the banks. Well, it wasn't quite net because the swap dealers added 4,300, but the producer, merchant, processor category sold some longs. But more interestingly, the managed money, which is the hedge funds, they knocked down their long position by almost 50,000 contracts. So usually when you see the hedge funds selling their longs, and oftentimes it's accompanied by jumping into the short side, and you see the banks reducing their net short position, that's usually indicative that the latest sell-off phase that we're in is pretty much over. And I have a feeling on that fat finger day, and that'll show up in tomorrow's COT report, I have a feeling that fat finger day, I think the banks probably covered up a lot more of their shorts. Because if you look at the producer merchant short, net short position, they're still very net short. And, I just get the sense that they're trying to cut down their short positions by quite a bit. And, again, to me, that's one possible signal that we could be headed higher.
And it also is the timing is right when they're doing those kind of raids on the Sunday money transition early in the morning, and the market's really thin. They get a lot of bang for their buck. The bullion banks will be able to short really without using a huge amount of contracts to affect the amount of price that they change, and then when the sentiment changes, they cover their existing short book that they were, nursing all along to manage markets. This whole rotation of moving around their book is something they can hide pretty easily within a 30-day window in any given month.
That's right. They're like China in that sense. They like to keep their paper positions hidden from the world.
I mean, they even play games around the 7-day cycle with the COT reporting and the cutoff dates for, when they collect data for COT. You can see market moves after cutoff dates all the time. It's like half of the time. So
they could do a COT report every day. They have all it does. You just got to run a computer program. I mean, the TOCOM, which is Japan's COMEX equivalent, they report the trader positions every day. So, I mean, there's obviously a reason why they're only reporting it once a week, and it's on a 3-day delay once it gets reported. I mean, it's insane. It's criminal, if you ask me.
So where do you see miners and institutional interest in the sector? Have you been getting people calling you up and looking for more information about what's going on in the sector in terms of institutional investors, what have you? What do you see as far as sentiment for miners and how that relates to precious metals?
I think what's going on, well, I mean, obviously the GDX hoopla really has influenced the market, which I think is nuts, because when you look at, I ran the charts last week, and since the GDX rebalancing, GDX has basically performed in line with the other broad mining stock indices. The thing of it is that the mining stocks are still largely non-institutional, especially in the United States. So, and that's to me where there's an opportunity for a lot of upside, because eventually a lot of these mainstream mutual funds will start having to put mining stocks into their portfolios. They were doing it before 2011. That was one of the things that started driving the Huey higher, and then they got scared out of it. But I think that the action that you're seeing in the miners doesn't really represent accurately what's going on in terms of capital flows, because I know from talking to, and I mainly focus on the juniors in my newsletter, so I talk to a lot of company CEOs, and they've all been telling me the same thing. When they need to raise money, it's not a problem. There's a ton of private equity type investment money in the United States and in Canada that will jump on a chance to buy new issues in some of these promising juniors. So I think the sophisticated investor class in the United States is not, they're not really paying too much attention to the day-to-day vicissitudes in the Huey index or the GDXJ. I think they're looking at now as an opportunity to invest in really high quality junior exploration mining stocks that have promising resources. And the washout from 2011 to the end of 2015 really created a lot of opportunities to buy into juniors that have promising properties, and some of them are companies that were formed because they were able to buy smaller properties that the majors were kicking out of their property portfolio at very cheap prices. And it's for a junior, if they buy a property and develop it and it has a couple million ounces of gold, and it looks like they can become a 200,000 an ounce a year producer, that creates, in this market right now, that company's worth $200 to $300 million. And so if they bought the property for a few million, that's a nice return on their money, right? So that's the kind of opportunities that were created from the big washout that we had, and they're still out there. And I think that's the type of thing that a lot of these sophisticated investors are buying into right now. So what do you guys think about Andrew Maguire's prediction here? Because I think correct me if I'm wrong, Tuesday is July 4th, and 26 days from the date that his interview on King World News was posted is July 5th. So,
Yeah,
I like, it's fun to talk about what's going on in the market now, but I'm really curious to see if what he said comes true.
I think I calculated based on when the interview was recorded, and I got July 3rd. So anyways, somewhere around there early next week with the U.S. holiday.
Maybe we'll wake up and gold will be at 2,000.
Go ahead, call Bo Pullman. Well,
you tried to mutter that under your breath, but we heard that, Eric.
Yeah. He didn't specify what exactly was the specific catalyst that he saw, but presumably it was like, stress on the physical system with bigger order flows that he could see coming at some point, be a sovereign or, burst of client activity, presumably. And you were talking about that a bit before the show, Dave, so why don't you just dive into that and explain what you think may have been his rationale?
Well, I mean, as you mentioned, he said he wasn't at liberty to specifically explain what the catalyst was going to be or what the event. And I went through and I listened to every word of what he had to say on that interview. And it was fascinating. And if you're full of hope, it was a great interview. And, I really hope it comes true. But I think the only thing I can figure out that may be a possible event, and this may not even be it, and this may be way off base, but he was talking in his interview about how there's what he calls a sweet spot in the LBMA OTC call options at the 1260 area, which I assume means that there's a lot of sovereign and wealthy and institutional investors who are long LBMA over-the-counter call options on gold at 1260. So, because he mentioned in that interview, he goes, if you look, they were able to get gold below 1260 briefly when they got it down to 1215, but then it bounced immediately because he said a lot of these people who were willing to pay 1260 for gold jumped into the market and started buying a lot of physical. And I can confirm that with the numbers that I see every day from coming out of India and China. So, I'm guessing that he's thinking that these people who have these call options at 1260 are going to exercise them and stand for delivery of the physical because it's a huge amount, and they wouldn't be able to buy the amount that they're looking for whenever the price of gold gets hit. They wouldn't be able to stick a huge bid in the market, say at 1220 or 1230, and buy the amount of gold that they're standing for at 1260 because everyone would front run them and push the price up a lot higher. So, if you're a big long-term investor in gold, I don't think, and you're looking to buy a huge amount, I don't think you really care if you pay 1260 or 1230. You just want to be guaranteed delivery because in this market, in the way, you see backwardation in LBMA forwards, there's occasional backwardation on the COMEX. That means that there's, the physical supply of gold that can be delivered and delivered off exchange, meaning the buyers want delivery outside of the COMEX vaults, or they want delivery outside of the London vaults. They want it delivered to their doorstep or wherever they want to safekeep it. When you see backwardation in the market, it means the supply of gold that can be delivered on that basis is very thin relative to the amount that's being demanded at that time. So, and this has always been one of the mantras of the hardcore gold investing community is that, physical possession is the number one and most important criterion in the gold market. And that's why China and India, the Indians, they want physical delivery. They want to hold it in their hands. The Chinese, every ounce of gold that's sold in that country has to run through the Shanghai Gold Exchange. Those are physical delivery contracts as opposed to the COMEX or the LBMA. They might say the LBMA is physical delivery. Well, you stand for delivery on your forward contract and we'll hold it for you in our vault. Well, that doesn't mean that the gold's necessarily really there. You have to go in and inspect it. And I don't think a lot of people do that, much ultimately to their detriment. So I guess my point here is that there could be a large number of people who Andrew Maguire has been told are planning on standing for delivery at 1260 and exercising those options. and it's a large amount of physical. And as I mentioned, they don't care if they pay $12.30 or $12.60. They just want guaranteed delivery. And so that's the only thing I could figure out from what he had to say in his interview. And again, I want to qualify that by saying it could be something entirely different that comes out of left field.
Yeah, I took the same interpretation in terms of what mechanics he was pointing at or thinking about that he wasn't at liberty to speak about, even though his words were implying that he had vision on order flow of some sort related to his position in this company. But the time in which he made that call, it was around the time we were going to be testing that 1,300 level in gold. And then the markets were pushed back down again just because, that's the way the cartel is trying to affect a sentiment shift so that they can liberate more people to sell into the market at a later date, even when people are looking on the other side of that trade to accumulate physical. So, a lot of people hear calls like this and they get their expectations set higher and higher and higher, and then calls fail to materialize because we've had just a whole series of that given the way this market has been manipulated. And it's unfortunate that a lot of people take that home message of giving up their insurance just because pundit after pundit have pointed to how things are going to go sky high, and it just doesn't happen, and people get frustrated.
It's playing out in bullion numbers. I mean, if you look at Silver Eagle sales, they've plunged back to pretty much the same as they were in April. We had, about a 2-week spurt of buying in early May where about 2.5 million Silver Eagles were sold. And now this month in June are right back to under 1 million coins sold for the whole month. 911,000 right now. Almost the same as April, which had a whopping 835,000. So the U.S. Mint isn't even selling 1 week's output for the entire month. Basically, the second quarter here, outside of a 2-week period in May where the price dropped a couple bucks and demand picked up for about a week, or for about 10 days, 10 to 14 days here. And really the same thing with gold. Gold Eagle sales are down to, let me refresh the numbers here right now. In June here, the Mint has sold a stunning 3,500 gold Eagles, 0 half-ounce gold Eagles, and 2,000 0 quarter-ounce gold Eagles, and 2,000 10th-ounce gold Eagles. So a stunning 5,500 ounces of gold sold in June.
Wow. What are premiums doing?
Half of that.
Yeah, I mean, premiums are the lowest on gold. Premiums are the lowest I've ever seen wholesale. I mean, wholesale premiums on gold, backdated gold Eagles are the lowest I've ever seen, about half of what they normally run. The wholesale premiums are about half of a current year coin on the wholesale market. Usually they're within maybe 10 to 15 basis points below a current year gold coin. So it's pretty unusual and astonishing in what we're seeing in the backdated market in gold. I mean, the retail investor demand has just fallen off a cliff here in June, both in gold and silver.
Yeah, well, it's important to point out too that whole trend of the U.S. coin and Canadian coin sales going down has been with us all year, and the price of silver never got below 13, and it's turned around. And even though we've had an enormous amount of manipulation, it's still holding in there. So, the traditional argument is that, the retail sales are horrible and demand is horrible, but it doesn't even jive with the actual price action that we've seen. And Asian demand has been huge.
I have just two comments about the retail market. One is, if they're selling, if U.S. retail is buying 40 million ounces of Silver Eagles a year? Is that about right? Just more or less? Ballpark. I mean, that's 5% of what trades globally. What is it? Something like 800 million ounces a year are sold globally, or between 800 and 900 million. So, I mean, I don't see the U.S. retail buyer of Silver Eagles as being the swing influence on the price.
The sentiment gauge for the rest of the retail physical market. I mean, all the other generic products, whether that's generic rounds, generic multi-ounce rounds like 5-ounce rounds, 10-ounce rounds, generic 10-ounce bars, 100-ounce bars, 1-ounce bars, that more than That's way more than the Silver Eagle numbers. And then you've got other sovereign products like silver maples, silver fills. I mean, maple's really the big one. But even then the other sovereign bar products like 10-ounce RCM bars, 100-ounce RCM bars, those do a lot of volume too. So it's definitely a sentiment showing what the whole physical market's doing. So yeah, I agree that just the Silver Eagles are just a fraction. But the total overall investment demand for silver can kind of be gauged by the government numbers, which are really the only numbers we have access to looking at.
Well, I agree with that, but I would qualify that by saying the retail sentiment in the United States.
Right.
And I think it's both sentiment, but also I think it's in line with just general retail sales spending and auto spending. I think it's in line with the fact that the average American household has a declining level of disposable income. And so if you're, at the end of the month, if your decision is, well, pay the mortgage or call Silver Doctors and buy another 5 or 6 rolls of Silver Eagles, what are you going to do? You're going to pay the mortgage. And I think that's also influencing the demand numbers in the United States.
You don't know some of Doc's customers. They might skip a meal for a couple of extra rounds.
Hey, you mentioned the silver maple leaves. I had never bought silver maple leaves before. I've always been a Silver Eagle guy, but Doc ran a sale on maple leaves, I don't know, 3 or 4 months ago. So I ended up buying a handful of rolls of maple leaves. It's a beautiful coin.
Just don't look at the queen face.
That part's not so beautiful.
What's the premium on the 1-ounce gold pandas? That's my favorite gold coin.
Well, they don't make them by an ounce anymore. Now they make them in gram denominations. So 30 grams is the closest thing you come to an ounce. Those run ballpark, I think 4 or 5% over spot.
The 30 grams, so it's 28 grams to an ounce.
It's about, if the conversion to troy ounces, I think it's 0.9645 ounces.
Okay, so it's about 4%.
So you can buy them for about what the spot price of gold is.
$45 or $50 over spot.
Yeah,
that's not bad.
So it comes close to the spot price of gold, since it's just under an ounce of gold.
Right. Yeah, I remember. I've seen the pandas be anywhere from north of $100 an ounce over spot to, I think the cheapest I ever saw them was a few years before Tolving went belly up. I was able to buy a couple rolls of gold pandas for the fund I manage, and I think I paid 40 over spot at the time. And I had to do a double take when I saw the price, because around that time every other dealer was selling them for 80 to 100 over spot. Yeah, the pandas are a interesting little market. There's a lot of collectors that collect them because, of course, the U.S. Mint and the Canadian Mint, we can't afford to ever change the design. The U.S. Mint's had the same design in the Silver Eagle for 30 years. They couldn't even do anything for the 30th anniversary. But the Chinese actually put out a new design every year, so they basically become collectible, and they only produce the coins for a little over half the year, and then they're hard to get, and it's kind of a mad scramble because people collect all the different designs. So us here in the West, we can't put out anything but the same design year after year. we wouldn't want to actually have any reason to entice people to buy a new coin. I'm sure that's part of the reason.
Well, we were talking about just a struggling, retail buyer in the silver space, and it's a pretty decent segue, Dave, to jump to where you think the U.S. economy is going, global macro more broadly defined. You track that with your short sellers journal and looking at retail space and real estate and credit cycle, and all of the various signs point to pretty nasty recession that you're either in or on the horizon of. And all this hype about, Trump's bringing in an infrastructure spend program, tax cuts, reforming Obamacare, on and on. I mean, his entire agenda has largely been flushed down the toilet. And all of the 10 11% gains in the S&P 500 that have been built on that since his election, just kind of precariously hanging over the market. I mean, the economic statistics have been coming in pretty negative all throughout this year, yet the market still elevates. What's your take as far as where we are with the economy and where that'll cross with alternative assets at some point?
Boy, I'll tell you, the way the market ran up after Trump's acceptance speech or victory speech election night, either that, that's a real lesson in the degree to which humans are driven by hope, hope and faith that's not supported by facts, or it was just unadulterated central bank intervention driving the market higher to try and make people feel good and go out and borrow more money and spend. But at some point, this thing's, that big balloon that blew up since the election in the markets, in the stock markets, it's going to pop and it's going to be ugly. And, I know I'm chiming in with the rest of the chorus, but I've been saying that for a while. If you look at the numbers that are reported that are available from non-government sources or non-government influenced sources, I mean, the economy is already in a recession. Retail spending, auto sales have started to roll over. GM just announced, I think it was earlier this week, their days inventory of cars is like 110 days worth of cars, and what's normal for them is more like 60 or 70. So they said they're going to get it down to 60 or 70. Well, they're going to have to do that into a climate where auto sales are starting to decline versus last year. So, I mean, we're under a 17 million run rate now, and I think we almost hit 18, or we might have topped out over 18 in that insane run-up of debt-fueled auto buying. But, for GM to accomplish that, they're going to have to start closing some plants, or at least mothballing them for a while. And that's going to affect the economy, retail sales. And it's not that Amazon is the retail killer. That's the fake news propaganda that's being promoted. I mean, on a nominal basis, overall retail sales continue to grow. Nominal meaning inflation-driven numbers. And if you look at non-e-commerce retail sales, it has small nominal growth. And another good example is Bed Bath & Beyond took a bath last week in its stock because it reported it really badly missed its earnings, and they said, well, Amazon's the culprit. Well, that's not true, because Bed Bath's e-commerce sales were up 20% year over year for the quarter. So if anything, a lot of these companies like Walmart and Target and Bed Bath, they're taking off the gloves and they're rolling out their own e-commerce models. And that's going to eat into Amazon's market share, as opposed to supposedly Amazon eating into the brick and mortar market share. So I guess my point here, it's a long way of saying that, retail sales, despite what's being said about Amazon, people have less money to spend, and that's a problem. And then you're starting, to me, the biggest telltale is the consumer credit numbers, because consumers are taking out a lot less debt every month now. For several months, it's been decline in the amount of credit being taken out, and that's everything: credit cards, auto loans, student debt, etc. And to the extent that economic activity has been driven by a massive increase in credit since 2010, if consumers are not taking out debt and spending it the way they had been, that means they don't feel good about their future. So, unfortunately, we're in an environment where the fake news headlines and the propaganda tends to overwhelm the truth. So you read these headlines about housing sales or GDP revisions upward, and it's like nothing could be farther from the truth. In fact,
yeah, and you know what's so fascinating too, Dave, is that actually people are seeing through that now, and even stats like the University of Michigan's Consumer Confidence Index is showing a downtick, and that typically, it'll track very closely with where the Dow Jones Industrial Average is going and where those topical kind of looking glasses into the economy suggest things are going, but even the consumer's not buying it. Literally, they can see through this nonsense. So even the propaganda and the way in which there's a divergence between the actual sentiment gauges and stock market performance is breaking down.
Yeah, I would agree with that.
So that's the first time we've seen it. I mean, the consumer confidence stats were pretty high back in November when Trump came in, for example.
Yeah, again, and to me, that just reflects the insanity of just blind hope, because that's what drove that number. I mean, it's the same thing with the home builder sentiment number. I mean, it hit, just a few months ago, that home builder sentiment number was as high as it ever has been. It was up at 70, and it's only been at 70 a few times in the history of the report. But at the same time, we're seeing housing starts have been declining for like 3 or 4 months in a row. So if home builders, and also this idea that there's low inventory out there, well, there's not low inventory because home builders have a lot of inventory on their balance sheet. I look at all their balance sheets. And if there was a shortage of homes, why would home builders be reducing the number of housing starts that they're engaging in every month? I mean, they see the market as well as anyone, so if they're cutting down on their number of new starts, is the market really short on supply? I don't think so.
Yeah.
And then the pending home sales contract, which is for existing home sales, the National Association of Realtors, that's declined 3 months in a row. That's based on contracts that are signed. The existing home sales numbers itself that gets reported is based on closings. But, if people aren't signing contracts, it means the houses aren't going to be closed, right? There's no homes to close. So you've had existing sales, pending home sales contracts declining 3 months in a row. And this is supposed to be the peak buying period of the year. So, it just tells you there's something going on at the consumer level. And I think they're tapped out on the amount of debt they can assume.
So as we wrap up here, Dave, what's your outlook going into the fall? I guess for the broader markets as well as the metals.
I'm always hopeful. I'm guilty of hope also. I'm always hopeful that the metals are going to shake the intervention and move higher. I think a lot of the fundamental catalysts that are driving the economy lower, and then layer on top of that the escalating geopolitical risk factors and the unpredictability of Trump factor and the unpredictability of the deep state factor. And it just seems like every day the fundamental variables that should be driving gold a lot higher get stronger. And, again, I still, we're about halfway through the year. So I said at the beginning of the year, after I said I'd never make predictions, that gold would end up higher at the end of 2017 than it was in 2016. And I still think that is going to be the case. And if it's not the case, then I would just say, well, it's the market hasn't been able to shake the derivative paper gold intervention. In terms of the stock market, the last 3 days, including today, have been interesting because we had a huge down day on Tuesday, and then a V rebound that took back all the losses from Tuesday, yesterday, and now we're even lower than we were on Tuesday's close. And we haven't seen that I can recall for a while, where you get, the V rebound. Usually the follow through on a V rebound is higher again. And the market took it right back and more. And I think that's potentially bearish. At some point, as Eric pointed out, the fundamentals are completely disconnected to the downside from where the markets are valuing the fundamentals. And at some point, there's going to have to be some sort of correction there. Either the economy has to start screaming higher, or the market's going to have to start screaming lower. And I think that's what's going to happen.
And before we wrap up, we would be remiss if we didn't comment about the U.S. dollar and its lousy action recently, too, because that is quite a disjunct from what's going on with the price of gold in this last week in particular. Now we're down to 95 handle on the DXY index, we've seen a considerable amount of downside acceleration this week as well. And that's reflecting this really poor outlook on the U.S. economy and lack of catalysts on a going forward basis with the morass of what the Trump administration's, economic policy outlook looks like. Even the IMF recently was saying, the U.S. dollar is 20% overvalued. You got a problem when the IMF is looking at that and being willing to be honest about where the dollar is. So, and usually they're trying to obfuscate stuff like that, is my point. At some point this year, the ever rising the higher lows that we have, in gold, sending the signal to even the paper traders that the market is alive and well despite the nonstop bombardment from the manipulators. There's going to carry on paper buying, and the physical buying is stronger around the world other than the U.S. coin market. These fundamentals are the strongest that I've seen for precious metals in a long, long time, and the economy is definitely rolling over. It's all credit cycle linked too. That's really the big untold story, is that you have central bankers in the West at least talking up a good game about shrinking their balance sheets, even though they can't. And the amount of credit that's been coming out of places like China has been curtailed massively since the 2006 or 2016 levels. China was responsible for something like 40% of the world's growth last year because of the amount of credit that they dumped into the market, and they've stopped doing that. So the markets are led by liquidity, and liquidity is declining, and at some point this levitation in the standard equities market has got to crack. I think the bond market's telling the truth, and the equity market is, on some kind of recreational drug.
Well, that's
central banker liquidity to the tune of $300 billion per month coming in the first half of this year, like $1.5 trillion. Huge liquidity infusions, and that is going to fade.
Eric, that's a good point about the dollar. I looked at it before we started doing the podcast, and I wanted to mention that. I mean, the dollar looks like it may go down and test the 90 area again at some point. And
I think that's in our future within the next 12 months, easy.
Right. But see, a lot of people are whining because the dollar's going down and gold's been going down. And there have been certain periods of time when the dollar's gone down and gold has gone down in tandem with gold. And that usually precedes a big move in gold. So, I think at some point the reality of what's happening to the dollar, and you're right, it really, that reflects more of the fundamental underlying reality of the U.S. economy, as does the bond market, than the stock market does. And at some point,
and political confidence too. A lot of times the dollar will reflect pretty big hits and changes in the assessment of the safety of the United States and its political continuity. And the stuff going on with Trump is definitely shaking that.
That's right.
Towards the middle of summer here, hopefully things will start heating up quickly for the metals in the second half of the summer. Like you, Dave, I'm pretty optimistic for really the whole second half of 2017, but really I think it could start as early as this summer. So we'll keep an eye on it, and if gold's able to retake that 1,300 level, I think things could get exciting. I'm hopeful.
I second that.
All right. Well, Dave, it's always great having you on the show. Thanks for joining us again.
Thanks again for having me. I love doing the show with you guys. I always get a lot out of it.
Yeah, and you produce a lot of articles, too. They're available up on your website for free. People can check them out at investmentresearchdynamics.com. Dave does great work. He's got 2 newsletters up and running, and you do $20 a month for each newsletter, right? And discount if people want to get both.
Yes, that's correct. Oh, thanks for mentioning that. I just wanted to mention briefly the next issue of the Mining Stock Journal, which is out today, is at subscriber on a subscriber request basis, because I had a bunch of subscribers asking for this. I'm summarizing all of the companies that I've presented in the Mining Stock Journal, and there's a couple that I've put outright sells on. And I also am including a glossary of each issue by date of issue with the name, the mining stock that was the main presentation for that issue. So it's something I should have been doing for a while, but I finally got around to it. today, and that's going to go out today as well. And new subscribers get all of the back issues.
All right, so you can check that out at Investment Research Dynamics. Well, we'll wrap the show there. So for the doc, Eric Dubin, and our good friend Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.